Hello ladies and gentlemen, and welcome back. In today's video, we discuss what just happened on the markets across the world. Of course, the Federal Reserve came out, they raised the rates 75 basis points. This was much in line with expectations, but what wasn't in line with expectations was the dot plot. But don't worry, Papa Powell said you can trust him, and he's got a plan. Today, we go through what the bonds market thought of this event, and of course, what we expect to happen next, as we've just hit the level we've discussed now for well over a month. It's all happening. See you soon. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. Today, we'll go through the macro information, what was in this report that was so shocking to the market, and of course, then we'll go and talk about the key levels that we need to be looking at for both lead indicators and the main markets around the world right now. Well, the dot plot was revealed and it shows that the Fed anticipates more hikes in 2022 and 23, and more importantly, that they're pushing upwards of maybe 4.5 to 4.75%. This is what the market didn't expect. The projections from the Fed. Take a look at this. In 2022, some of them, and it seems like a majority of them, have pushed a higher interest rate than anyone thought was going to happen, upwards of 4.5%, 4.25 to 4.5%. This is not what the bonds market thought. They were thinking 4% by the end of the year, 4.5% potentially by April of 2023. Well, things have changed. Faster, harder, quicker seems to be the way that the Fed are looking at it. And of course, they believe that they're going to beat inflation and that rates will go back into where they are realistically right now by 2024, 2025. So a longer expectation, a longer stability of higher rates because of sticky inflation. The whole time this has been happening, nobody's talking about this. 10-year Japanese government bonds. No trades going through literally for 2 days. Now, for anyone that's been following the channel for a while, you'll know that the Bank of Japan is trying to stop inflation, or at least pretty much cause deflation, at the same time that the US market and the rest of the Western world is realistically seeing some form of really runaway inflation. This is not a good scenario, and liquidity is drying up as the Central Bank of Japan has literally just continuously purchased their own bonds. And of course, they're trying to support this. The differential between the two yields in the countries now is massive. Of course, the higher the Fed goes, the more pressure that's going to be put on the Bank of Japan. Will they fall? Will it crumble? Will it cause some kind of crisis? We need to start watching that on the charts. And we will be following the Bank of Japan US 10-year over the next coming weeks, and make sure to subscribe if you're interested in more of that content. We brought this one up in the previous video. The SP 500, after a percentage of treasury yields, we're at 250-day cycle highs from less than 20% to over 98%, a big reading that often caused realistically kangaroo-style markets to weakness in markets over the next 1 to 6 months. This is a big reading and it's going to have dramatic ramifications throughout the markets out there. Remember, what we're probably going to see is compression of PE ratios. Big tech stocks are going to be hit by that because, as we know, they trade at very high multiples. Compression of PE ratios really hits the risk side, and that's what we saw in the aftermath of this big announcement of course, the Fed coming out with their crazy dot plot that seems to show us that there is further work to be done to kill inflation, and the Fed seems committed to trying to do that. Now, what's happening? Well, we're entering into gold seasonality. That is a bad time of year for gold, and as we know, gold hates really high yields. So this is going to be a very difficult time for gold. We'll take a look at the charts a little bit later on. For anyone that hasn't been following as well, in general, it takes 8 months from the last hike, which is now still expected around April of 2023, to the first cut. So don't expect this to just be rate hike, an instant cut. It's going to be rate hike, stay there for a while hopefully inflation gets underneath the number. They'll keep it there for as long as they can to try to get inflation down to their core 2% kind of concept. And then they'll do the cut after they've got it under control. Here's some stats from previous history. We know, of course, September and October are the worst months of the year, including, of course, midterm election years. We've talked about this a lot. We expected the back end of this month to be weak. So far, so good. It certainly has been weak. And we know that we're in a bear market at this point. So what's the general length? Pause the video here if you want to have a look over since the 1800s in bear markets. But it's this chart I want to talk about. Job done in terms of our initial correlation. Remember, we talked about it up here. Now the market is all the way back down into the first zone where things could turn. Now, it doesn't look like on the surface things will turn. Of course, most people are going to be running around saying new lows are coming. And the most correlated market at the moment is actually 2008 to the current stock markets across the world. But it's interesting. We finally found the initial double dip. The 1962 strategy has worked out. And this, of course, is something that we've followed now for over a month. And it's just interesting to show how these things play out. I haven't changed that slide ever since that point, and you'll notice that it's really been well in line with all of those concepts. Do remember, of course, we're in a midterm election year. Although we have inflation over the top, we also know that after the midterm election or around October 15th, we do sometimes see reprieve in the markets. October 16th, funnily enough, is the CCP's meeting, which is the Chinese Communist Party's meeting. That's going to be a very important pivotal point here for inflation moving forward. Will they continue to sit there and say that they're going to have a COVID zero policy, or are they going to flick the switch and move to some kind of now opening policy? If they move to opening, maybe we've seen the peak of inflation. If they continue to have a very regimented lockdown policy, maybe this problem continues for even longer. That's going to be pivotal. We'll talk about it. And I believe no one is discussing this realistically on YouTube or on the internet, or at least not many. It's important to think about. 20 on the fear scale, of course, or 35 on the fear scale of the VIX is the most key levels. Though a lot of people have messaged me and talked to me about this. They've said, Tom, why is the VIX only at 28 considering what just happened in the last 24 hours on the markets? The real key to the VIX is if we're in uncharted territory, that is, we've made a new low on the stock markets, we tend to see the VIX rising. If we haven't done that, and we're in a charted zone, which we still are, remember we saw this only back in June and July, this level, then we don't tend to have as much fear in the market, and the VIX doesn't seem to be as high. Long leg doji on the VIX, not much to report there. Let's take a look at the US 10-year versus the US 2-year though. Look at the US 2-year, 4.11%. I would not have expected this a month ago in terms of to go this high and to have this runaway kind of 4.112%. We already expected the 2-year to go up, but here's the problem, or here's the thing. This is showing that in 2 years' time, that's the rate that's expected. That's what it's showing us. Well, more importantly, take a look at some of these readings. Here's the December read from the market. December of this year, 4%. Another 75 basis points hike expectation. Here's where things get really crazy. April of 2023, 4.6% now, taking into account, I believe, a lot to do with that dot plot from the Fed. And then the next one, September 2023, still almost the exact same levels. So they're expecting a 4.6 to 4.75% rate. And then that's going to stay stable for, well, history has told us, potentially 8 months. Imagine the damage that's going to do to the economies around the world. They seem to committed, and again, they reiterated, we're going to do it. Trust us. This will work. We'll find out whether it does. What type of damage does it do, more importantly? Let's take a look at what the bonds market thought about this. Well, of course, high yield corporate bonds did drop. They didn't make new lows yet, importantly. So we'll continue to watch this one. High yield corps didn't. I did say I'd update you on my lead indicator. Still no new lows on the lead indicator for bonds either, but it did drop during the session. Some people have been sending me tips. That is treasury protected kind of bonds. You'll notice that they're down heavily. Now, a lot of people have been correlating this with the market this year, and they're saying, look, when TIPS has made a new low, it has followed through to the SPY or the SP500 making a new low later. And if you look at some of the correlations, you can see why. Yeah, it's a fair enough chart to bring up to a degree, and you can tell that when we had these kind of peaks, we often saw significant downturns, and we're on a new low now for TIPS. So something that can be correlated, maybe you want to bring it up. We'll do some more work on this over the subsequent videos that we'll be putting out over the next couple of days. Here was probably the crux and probably the biggest telltale sign that things were maybe going bad. For whatever reason, the US dollar went through our 110.25 level. It then breached the peak. and it went ballistic. 111.65. The US dollar is an unstoppable force. As we've talked about all week, this chart held the keys, and of course it broke out past our 110.25. There were some good trades, by the way, to do the short here into this level, but then it broke out and it was on fire for the rest of the session. 111.65. Let's put this in perspective of over time. Let's actually go back to history and look at how high we're going. Is the US dollar going all the way? Previously we kind of stopped around that kind of 112.80. Are we going though to a 120 US dollar? A few people are starting to talk about this. And look, if yields keep rising, don't expect the US dollar to slow down. It's going to be very important to watch this. Between now and October 16th, we could see some runaway DXY. But after that date, maybe things will change. So US dollar will be one to watch and to follow through. Of course, this had dramatic ramifications for things like the euro. The euro fell through the floor. We talked about the series of lower highs coming in on the previous session, and it just got destroyed. 98.15 for the euro by the end of the session, and it was down very, very heavily. If we take a look at it, you can see a new low formed and just continues in the trend against realistically the euro, and more people are just going to safe havens. Swiss franc, US dollar, they seem to be the main safe havens, as the Japanese yen, of course, is being manipulated at this stage. What about gold? Well, gold held as best it could. It is at pivotal. We know it's going into bad seasonality now. The good seasonality is over. The good seasonality pushed it. It fell. It held as best it could. I'm not feeling that bullish on this level, but time will tell. Of course, we're at the last kind of echelons of will it be successful. If the US dollar continues strong, expect gold to fail. Gold hates high yields as well. It may drop into 1582 or even 1461. It may be worthwhile setting alerts down at these lows and these highs around these zones, 1600 maybe in the future if you're a gold bug, because if it does get down these lows, there could be some long-term opportunities there when things eventually switch. If we go down to the 1 hour, you can come and have a look at this chart. This was the announcement. We got that initial take of the low. It rallied up and then just busted straight down. We're still in the structure. We'll find out whether it can do it. Was this just a liquidity grab? It certainly looks like it. Here we probably have the order block. Here we have the resistance. And at this stage, new low. Watch out down below. It's going to be pretty scary there for gold. US oil is pretty similar, holding as best it can around this weekly kind of previous closure. You'll notice that it's currently at the time of this recording underneath. Every time it's found bouncing here, will it again? I'm not so sure about that. Demand destruction well underway. Yes, we have inflation. Yes, we have a high federal funds rate, but realistically, this, I believe, is going to be demand destruction. Going to 4.5%, going to 4.75% in the US. It's going to put a lot of pressure on oil. And I've talked a lot about how I believe oil is going to go down over time. If you have a look here at ZOM, which is of course ExxonMobil, you can see that it's kind of peaked, dropped, pulled back, and it's looking pretty damn weak on a chart. So again, not much to like about oil here moving forward, in my opinion. Tesla dropped right around that zone. This was the area that we thought we'd see the sell-off in. Oh, we got close. We got really close. Of course, we just saw this high. We tapped a new high, and then it was sell-off city. If we go into the 2 hour, you can see how it did it. Nasty if you had a sell here. You may have got stopped off. This is the problem with these retail traded stocks. They often do go a little bit higher. You would have had to have your stop above here. And you can see it went bullish, bearish, rallied, dumped. And is there more to come here? Well, we'll take a look at the stock market. It looks set to open a little bit lower though. I'd probably expect it to open somewhere around that 295 at the time of recording, or even lower for Tesla. Microsoft dropped through its initial low. It's back on this key critical 238. Even if it rallies here, do we get set for this kahuna zone? Basically the trend line of everything we've discussed in the past. Trend line coming through, previous resistance, previous support, massive level through 225. Let's take a look at Google. Took the low. Do we see some reprieve bounce in the next session? Certainly possible. We took the low. We've got the gap here. A lot of people will be looking for that gap or even movement down. I think if we do see rallies, they'll most likely be met by sell demand in the future. And we might even see movements all the way back down into this zone. A lot of people are going to like the 80s for investment on Google. Gaps, all sorts of things going on. But the next session, the way it interacts with this zone is going to be very important. So watching the session on Google could be worthwhile. If it keeps dropping, of course, we have to expect it to potentially drop into the 90s, or the low 90s, early 80s. And I think that's the next zone for it. Meta, 2020 lows, not quite there yet. You can see we're dropping down. Do we end up swinging that low and that's where the bulls come back in? Watch this one on the charts. It may be worthwhile. DAX, right on support. Previous buying demand we've seen before. This time, I think it's a big question mark whether we bounce off this zone, but it is at the right structural level. And this is, of course, the time of recording. Should we bounce or go through here? 11,500 could be the next level for the DAX. Here's where things, of course, get pretty crazy. What happened here on the Nasdaq? Well, the Nasdaq was the sneaky one. The Nasdaq came up during the market. You can see it went down. It came up. It took the high here and just got destroyed. If we take the percentage of the move here from the high, some people may have been able to actually extract 4.8% from the move. It was a pretty significant sell-off here for, of course, the Nasdaq. We saw a big take of the liquidity, and we're now back into what we found as a very heavy demand zone. We've had this one boxed for ages. We've just hit into the box. What I'd like to see here is buyers. I would like to see structural setup, which unfortunately may take 1 to 2 days. Follow along on the channel because we'll be talking about this a lot. And if we do get buying structural setup, there could be a good opportunity here for the short term. A lot of people are going to say, well, I'm going to try shorting it here. This is not the place you want to short this market. Where you want to short this market was here. Potentially, you could have tried to short it in here if you did in the last day. And of course, previously in these zones. They were the best shorts. This is not the best short anymore. This is the level where you've got to consider potential turnarounds. Remember our double dipping scenario, which is still potential here. Even in the deep, dark recesses of hell, which we are in from the Fed processing and what the Fed's saying. We're going to go higher. We're going to go longer. The market has allocated some of that risk already. It's dripped down and we've got that doubling bottom, which we hoped for back over here. It has occurred. I don't see a catalyst right now to push these markets up other than just technical exhaustion, which is probably what we're seeing. But overall, it's when we make the new low that you need to pay a lot of attention, because where do we go at that point? Well, a lot of people have, of course, 10,000 on their Nasdaq, and the SP 500 will most likely show the way. Remember, we saw huge buying going on around this level previously during the dip purchase. We have an island that sits underneath the way that we found the low last time for the S&P 500, the island reversal, massive level there. We've got a gap that still hasn't filled between the 3700s and 36s. But more importantly, we're in that 3750. This was the area that we wanted to reach. 3750 to 3720, we expected the bounce. Do we get it? Do we find the bounce in this zone? It seems likely this will be where the market tries to find some pickup. And of course, we'll be looking for structure around here. Remember, practice patience to try to react to these positions. If you notice on the actual stock market itself, especially the futures market never trapped like the Nasdaq did. See, it never got above this high here, the 3920 that it formed. It just went down, up, then sold off. This is why I like the S&P 500 so much more than the Nasdaq. The Nasdaq gets you into trouble. It gets your stop losses hit. It's annoying like that. Unfortunately, that's just how it is. The US 500, much, much more technical. And you'll see at the time of recording, we've hit the promised box zone that I've had sitting on this chart for what seems like eternity. It's been there for a while. So we're at the support now in these markets. Do we find structural base? Unfortunately, it's going to be a waiting game around this area to see that structural base form. I hope we get some, so there's some opportunities there. Let's move over to Bitcoin. Bitcoin is just on its last legs. It went to a new low, pushed down to one of the weekly closes here. 18,000 pretty much flat, bounced off that zone. I've had this on the chart for a little while. And if we go over to the daily, remember, if we get underneath 17.6, watch out down below. There's not much holding crypto until 12 or 9 to 12K for Bitcoin. So the sell-off that could be affected here, should the stock market make a new low on crypto as well, crypto would be brutalized. And we do expect, based on historical stats, for crypto's low to be put in the next 149 days now. So somewhere between now and the 16th of Feb, and that may not sound helpful, but it's interesting how they're all synergizing together in terms of these markets. We'll find out what happens over the next couple of weeks, but this is the brutal time. Everyone's going to start turning bearish. We're hitting these SUPs, especially in the stock market. We may get some reprieve around this area. We've finally hit the zone that we were looking for. Let's move over to a few other things. If you haven't already, come and follow us at FX Evolution. We always do post a bunch of Twitter posts. Obviously, we have a Discord community as well, both a public and a private Discord community. Do remember there's still a lot of news to come. We have monetary policy statements from the Bank of Japan. We have a whole bunch of other monetary policy statements, CHF. We've got the Great British Pound. Of course, we have the UK coming out. What is the bank going to do in the UK? What are they going to do with rates? Looks like they're going to push another 50 basis points. These are all going to be incredibly important aspects to this week's market, and hopefully will form some form of structure. For put buyers, you guys are celebrating. What a great day it has been for put buyers. But for, of course, people that are long in the market, well, we'll find out whether this low can hold, because we're right in that next 100 points, right around this area, where if the bulls are going to gain control, they should technically gain control somewhere in here. As always, if you're interested in anything else that we do, you can check out some of our courses down below. And thanks so much for subscribing and smashing that like button. We'll see you in the next one, guys. Bye for now.